Good morning and welcome to the Killik & Go podcast for Friday the 9th of January. This week, as the first week of January, has been a pretty interesting week. So we've seen bond yields and inflation expectations fall. We've seen the dollar and volatility rise. The bond market this week has been predicting that growth is going to slow through their interest rate and inflation expectations. So here we've got the five-year inflation expectations curve, which strips out the effect of near-term commodity price falls because it gives you the expectations for five-year inflation in 5 years. So as you can see here, it's fallen quite dramatically this week. The equity market's been dancing to a slightly different tune, and they've been paying more attention to the Fed comments. So we got more detail of the minutes from the last meeting that we talked about in the last podcast. And they're willing to look through the commodity weakness. They see that as transitory, and they're still concentrating on what's happening in the job market. And we'll get a key input for that data this afternoon with the non-farm payroll. What we're trying to say here, though, is that the market isn't necessarily going to go down in the States if interest rates start going up because that job market is tightening. And as you can see here, this is the US yield curve, which responds to interest rate policy. As yields have gone up, the PE on the market has actually gone up because it's reflecting better growth expectations. So we feel that the market is probably preempting a rise at some stage this year in the US yield curve, but you know, there's possibility that the market PE can continue to rise even in the eventuality that interest rates do go up this year. We also had a CPI, or Consumer Price Index, print for the Eurozone this week, which showed that inflation is now below zero. So we've got deflation in Europe. So that we feel will increase the likelihood of some sort of QE announcement at the January the 22nd meeting, and the market's starting to get a little bit more positive about that as well. Financial conditions in Europe are now very loose. So we're back to where we were in 2009 at the foot of the financial crisis. And this chart shows a composite of the 6 months change in the bond yield, so lowering interest rates, so lowering financing costs, the Brent oil price, which shows lower input costs, and the euro-dollar rate, which shows the competitiveness of the currency. And as you can see, Europe is looking extremely competitive at the moment, and we saw a very strong European market out of 2009 under those conditions because you saw good earnings growth because of the easy monetary conditions. In the US, we're continuing to see consumer confidence growing, and as you can see from this chart, we're still a long way off a peak in that sort of level of consumer confidence. And through our portfolios, we are trying to play this growing consumer confidence, and we feel that Wells Fargo is a very good way to do that. It's very domestically exposed, so it's not impacted by a stronger dollar, but you will see loan growth through higher confidence, and interest rates are actually good for their margins. So the case for Wells Fargo is that at the moment the loan-to-deposit ratio, i.e. what they're loaning on their deposit base, is relatively low, and as confidence grows, demand for those loans will increase. Also, as interest rates rise, the net interest margin that they charge or receive on their products will go up because they'll be getting higher yields on the products that they sell to consumers. So as a result, you get a situation where if you saw a normalization of their trading conditions back to 2009, you'd see around a 70% uplift in earnings. So with the stock trading on fairly trough earnings, but only on 12 times earnings, which is a substantial discount to the overall market multiple, we feel that looks like a pretty interesting play still. The week ahead, we've got the US results season kicks off. So we've got Alcoa, it's always the first to report. Of interest, we've got Wells Fargo, as I've just talked about. We've also got Ocado. We've got some interesting data from Schlumberger, which is obviously in the eye of the storm with lower oil prices as an oil service company. We've also got Tullow there on Thursday, and then Goldman Sachs will be of interest on Friday. Just looking at Ocado, because they're coming through next week, that share price has been strong through Christmas and the New Year, obviously coming off a period of material weakness. The case of Ocado for us still remains the same. We feel that like-for-like food sales over Christmas are looking robust. We've seen that from Tesco's and Sainsbury's and Marks & Spencer's, who've reported this week. The average basket size we feel for Ocado is starting to grow, so that's an important metric as they move into non-food and you get those higher price items. And the productivity of the business is continuing to increase. So online technology continues to improve, and as you go to the third, fourth, fifth generation warehouses, you're seeing a significant fall in costs per sales. So that fourth generation warehouse is twice as efficient as the first. We also feel that Amazon are coming into London in terms of Amazon Fresh, and they'll be looking quite closely at Ocado. So lots to look forward to next week.